Hello to everyone. Hello to our audience from across the world today. Thank you very much for joining in for a webinar that we think is quite a timely one. And I say this because in the context of the current macro environment, we have seen several question marks raised with respect to the efficacy of the traditional 60-40 equity bond multi-asset portfolio. In particular, the fixed income component of this portfolio is no longer considered to be very defensive at all, as we are facing the real threat of inflation, and we are facing a rising rate environment. And in addition, this macro environment and also the recent situation with the Russian invasion in Ukraine has also tested equity valuations, and we have seen some equity drawdowns in the first quarter of the year. So in today's webinar, we will try to demonstrate how investors can increase their allocation to the equity component, collect the equity and factor premium for a given level of risk, and additionally significantly lower their drawdown events. All in all, we'll try to show you that the risk-return profile of multi-asset portfolios can improve significantly if you use our dynamic defensive equity solution as part of the overall equity bond allocation. In addition, we'll touch upon on the important advantages of our dynamic defensive equity index, which offers, we think, an elegant and efficient solution to the drawbacks that traditional defensive solutions face and are available in the market today. So with this in mind, let me start going through the presentation. As a general outline, the presentation is following these steps today. In the introduction, we will see how defensive solutions make an important component of multi-asset portfolios. And additionally, we can see how our dynamic defensive solution can be a very useful tool for investors. Then, in the second part, we will move on to showcase some case studies, whereby we will see what the allocation to defensive equity can be using our dynamic defensive equity index, as opposed to a traditional equity portfolio or a traditional defensive portfolio. We will see that that a higher allocation can be achieved with the same level of risk, and you will get a lot of downside risk and return benefits. Then, in the third section, we will see how our index, our dynamic defensive index, is improving upon some drawbacks that traditional defensive strategies face. We will move on to show you some important results of the behavior of our dynamic defensive solution, and then we will conclude. So, as an introduction, we know that traditional multi-asset portfolios allocate to equity returns as a way to benefit from the equity premium and earn good long-term risk-adjusted returns. However, the traditional allocation to cap-weighted equity exposes investors to the drawbacks of equity market volatility, and this includes extreme events and tail risks. What this means in practice is that in an asset allocation exercise, investors cannot put unlimited amount, or let's say in a 100% allocation amount to equity, but they have to manage the quantity that they can allocate to the equity part in order to manage these important downside and extreme risks. One way that investors can address these problems, can address these limitations of the traditional cap-weighted equity allocation, is to try a defensive equity strategy instead. And the most usual, the usual suspect here is the minimum volatility portfolio. So minimum volatility portfolios, traditional defensive portfolios, what they do is they offer overall a better protection in downward market conditions, while at the same time they manage to offer better risk-adjusted returns compared to the cap-weighted index over the long term. This way, investors can achieve a higher allocation to the equity component in their multi-asset portfolio. And all in all, they can expect better long-term risk-adjusted returns as opposed to the scenario where they were only trying to use the traditional cap-weighted index. So there is a case for using defensive strategies in a multi-asset portfolios, and investors expect some benefits from this asset allocation decision. Nevertheless, traditional defensive equity strategies face some problems. And one significant problem is depicted in this slide. The audience can quickly see that two things are happening here. In the blue line, we have the rolling one-year volatility of a cap-weighted index, and in the gray line, we have the one-year rolling volatility of a traditional defensive strategy such as the minimum volatility portfolio. What we can see is that first, on average, or most of the time actually, the traditional defensive strategy has a lower risk, a lower volatility than the cap-weighted index. However, the second thing that happens here is that the traditional defensive strategy still goes through the same spikes of volatility, the same spikes of risk as the cap-weighted index during extreme market events. So when you need your portfolio to be low volatility, unfortunately, this traditional defensive portfolio still experiences periods or spikes of high risk. What we're trying to offer to investors is a solution called dynamic defensive equity solution, whereby on top of other benefits that we will discuss through the presentation, it offers investors the ability to manage these spikes of volatility much better. And as you can see here in the graph, the red line is depicting the rolling volatility of our dynamic defensive equity product versus the traditional min-vol portfolio and the traditional cap-weighted benchmark. You can see that our dynamic defensive is able to minimize these spikes of volatility during important high-risk events, therefore offering investors better downside protection. And the way this is achieved is through a risk control option called maximum volatility protection, which is overlaying our low volatility factor premium portfolio. And in the other sections of this presentation, we will see all the details of this construction. But in summary, this dynamic nature of the overlay is allowing the index, is allowing this strategy to build on the advantages of the low volatility factor construction that we offer, and additionally manage downside risks very well. To showcase this a bit more, in this slide we see a table which discusses some downside metrics for our dynamic defensive solution compared to MSCI min-vol and the traditional cap-weighted benchmark. you can see that the MSCI mean vol portfolio is indeed able to have a lower drawdown than the cap-weighted benchmark, but the dynamic defensive solution is able to go far beyond that. For example, roughly achieve a maximum drawdown of roughly half of what the cap-weighted benchmark is giving you. If you focus also on the distribution of the distribution of worst returns, we have metrics like the 1-year rolling worst 5% returns, the 3-year rolling returns. For all those distributional metrics, we can see that the downside risk of the dynamic defensive solution is much, much better compared to the cap-weighted benchmark, but also a traditional defensive strategy such as the MSCI mean vol portfolio. So investors have a nice tool in their hands to incorporate in their multi-asset portfolio and get the benefits of the low volatility, factor risk premium, and the overall dynamic defensive solution that we offer. As an outline for the rest of the presentation, what we will do next is we will go through 3 simple case studies that will demonstrate the benefits of our dynamic defensive solution instead of using a cap-weighted benchmark or a traditional defensive strategy such as the MSCI mean vol in the multi-asset portfolio. And to do that, the way we will demonstrate that is that we will aim to show the allocation needed for the equity and the bond component of the multi-asset portfolio in order to achieve the same level of risk. And we will do this in 3 cases. We will do it with respect to average risk. We will do it with respect to downside risk. For the dynamic defensive, the MSCI mean vol, and the traditional cap-weighted benchmark. Then, after we see these 3 case studies, we will go a bit more into the detail of the dynamic defensive construction. We will see the advantages that it brings and the solutions that it brings to the drawbacks of traditional defensive strategy constructions. And some interesting results with respect to the performance of this index. Okay, so to move on to the case studies and how the dynamic defensive portfolio looks like as part of a general multi-asset portfolio, we are going to go through these 3 case studies as depicted in this slide. So case study 1, we will try to target the average volatility of a traditional 60-40 equity bond allocation. And we will try to see what the allocation will be for the dynamic defensive and what the allocation will be for the MSCI mean vol portfolio for the same level of risk as the 60-40 equity bond allocation. We will do the same exercise with respect to 2 metrics of downside risk. We will for 3 cases, we will match the worst 5% 1-year rolling at -5%, and similarly for 3-year rolling returns, we will set a limit of 2% downside performance, and we will see what the allocation is with respect to the 3 alternatives: the traditional benchmark, the traditional defensive, and the dynamic defensive. And while we do this and we see the allocation differences, we will also see the differences in the distribution of returns. What are the benefits that investors get with these different allocations for the same level of risk? Starting with the case study 1, here what happens is that if you see the first column under the name scientific beta US cap weight, Here we have the traditional 60-40 equity bond allocation. And this allocation gives you an annual volatility of about 11.5% over the long term. Now, what happens to the allocation between bond and equity if you keep the volatility the same and you use defensive strategies? If you use the minimum volatility strategy, you can achieve the same overall volatility for your portfolio by having just an increase of your equity allocation of an absolute level of 10%. From 60, you go to 70% equity allocation. When it comes to the dynamic defensive, in order to achieve the same volatility of 11.5%, you can go all the way up to an equity allocation of 93% approximately. What this means in practice is that you can have less allocation to the fixed income component, you can have more allocation to the equity component, and reap the benefits with respect to your distribution of returns. If we turn now to the rest of the table, we can see that both the 1-year rolling average and the 3-year rolling average returns are considerably increased when you add the dynamic defensive setup. Similarly, if you look at downside metrics like the worst 5%, you can see that also these are much more improved if you use the dynamic defensive solution. And this is coming from two sources. It's coming from the ability to allocate more to equity and also from the ability of dynamic defensive to manage downside risks in an efficient manner. Moving on to case study 2, here, instead of targeting the same level of average volatility, we are trying to match a similar level of downside risk. And we do that assuming that all portfolios have the same worst 5% 1-year rolling return at a level of minus 5%. If the investor's risk appetite is set at this level, he will find an optimal allocation for the equity bond mix at a level of 36 equity, 64 bond if he uses the traditional cap weight. If instead she uses the minimum volatility portfolio, the allocation can be increased, but only up to the level of 48% equity, 52 bond. With a dynamic defensive, investors can go all the way up to an allocation of 67 equity, 33 bond approximately. And this, similarly to the previous case study, is giving a lot of benefits to investors with respect to their distribution of returns. Average returns are better, and also worse returns are managed in a very efficient way. So there's a lot of benefits for investors to pick the dynamic defensive allocation because they can, for the same level of risk, allocate more to equity and harvest more of the benefits of an equity and factor risk premium allocation. Finally, case study number 3 is targeting the same level of risk at the 3-year horizon. Similarly, the min vol portfolio is allowing you to allocate more into equity compared to the traditional benchmark, but nowhere near what you can achieve by using the dynamic defensive component. You can go all the way up to 92.5% allocation for the same level of risks, which again gives you very nice return distributional benefits in terms of average returns, in terms of best returns, in terms of worst returns. So these are the examples in respect to the multi-asset portfolio setup. And what we saw in these 3 case studies, these three simple but powerful case studies, is that the investor with respect to a 60-40 traditional equity bond allocation can actually allocate 33% more to the equity component if the investor is using the dynamic defensive portfolio. And this is already 23% more than what he would be able to achieve with a traditional defensive portfolio. In terms of returns, this means that for the 1-year horizon, it's an average benefit of 74 basis points. On a 3-year horizon, this is an average of 158 basis points benefit compared to the traditional 60-40 equity bond allocation. So these are the kind of benefits that the investor can start to see if he incorporates the dynamic defensive into the overall multi-asset portfolio. So we covered this important topic, and now in the next section we want to focus a little bit more on the construction of the defensive portfolio. We want to give you an idea of the portfolio construction and how this is already improving upon some important problems or drawbacks of traditional defensive strategies. First of all, to set the scene, the idea behind defensive strategies is that they can be useful in a multi-asset allocation because they can protect during downward market conditions, but also they can offer a nice risk-adjusted returns over the long term. This is possible because these strategies tend to have exposure to the low volatility risk premium. And this risk premium is offering positive risk-adjusted returns for investors over the long term. So with a defensive portfolio, investors get access to the equity premium, but they also get access additionally to the low volatility risk premium, and they can earn these benefits of better downside protection, but also better risk-adjusted returns overall. So how do you get access to the low volatility risk premium? Traditionally, people have are trying an optimization approach whereby the portfolio construction is based on searching for the low volatility portfolio, for the portfolio with the lowest volatility on the efficient frontier, and we call this the minimum volatility portfolio. However, this approach suffers for some drawbacks, and here we can show you how the low volatility factor portfolio from Scientific Beta, together with our risk control option, can solve these problems and give you a better strategy. First important point is that when you get access to a traditional defensive strategy, and we can see this on the right-hand column under MSCI minimum volatility label, you might as well get negative exposure to other well-rewarded factors. So what the MSCI min vol portfolio is doing is giving you a positive beta to the low volatility factor. These numbers are all betas exposures to the 6 well-rewarded factors documented in the academic literature. But at the same time, you see that it gives you negative betas to other factors such as value, momentum, profitability, or low investment. In essence, despite the 0.31 positive low volatility beta, the overall factor intensity of this portfolio is only going to the level of 0.16. So when you sum all these betas, you get a low factor intensity. It means that you get some benefit from the low volatility exposure, but you are living on the table, or you are actually being hit by negative exposure to other well-rewarded factors. What we do is we follow our classic factor investing methodology, which is applicable to all our factors, and we construct a low volatility factor seeking portfolio that is able to give you a high beta to the low volatility factor, while at the same time is controlling and most of the time giving you positive betas also to the other well-rewarded factors. The way to do this is through a two-step process. In summary, the first step is to do a portfolio, to do a stock selection towards low volatility stocks, which will be the first step to get this low volatility exposure that you are seeking. But at the same time, from this stock selection approach, you check the stocks and you remove those that have a very low or a very negative factor exposure to the other well-rewarded factors. So you end up with a universe of stocks that is able to give you a very well and very strong low volatility exposure, but at the same time is not suffering from negative exposure to the other factors. And you can see here in the table that the factor intensity, the sum of these betas, is at a level of 0.42 for the low volatility strategy, which means that you are adding more beta on top of your low volatility factor. And it's much, much stronger than the factor intensity of a traditional defensive strategy. What this means in terms of distribution of returns, for example, here we split the returns between periods where low volatility does well, the low volatility factor does well, and periods where the low volatility factor does not do so well. In both these regimes, our low volatility factor is doing better than the MSCI Min Vol portfolio, the traditional defensive portfolio. And the reason is that in these situations, for example, in the situations where low volatility as a factor is not doing well, you have these positive betas to the other factors compensating for any potential underperformance of the factor. So all in all, by being positively exposed also to the other well-rewarded factors, you manage to get a better distribution of returns, whether the low volatility factor is doing well or is not doing so well. So you solve this very important problem that traditional defensive strategies do not solve. Second, and this is important with respect to portfolio construction, our low volatility factor construction is paying particular attention to the topic of diversification. So once you do your stock selection that we described in the previous step, then you need to decide how to weight these stocks. And the most efficient way is to weight them with the idea of diversification in mind. So we pick a weighting scheme that is focused towards diversification of stocks. And here in this table, we compare our diversification weighting scheme with a more traditional cap weighting scheme that strategists tend to use. And you will see that the effective number of stocks, for example, is considerably higher in the scenario of our weighting, of our diversification weighting scheme. And this means that you take less unrewarded risk, you take less specific risk, you take less idiosyncratic risk, and this pays back in terms of returns and Sharpe ratio. Finally, one more benefit before we go into the management of volatility spikes, one more benefit is with respect to fixed income risk. So our strategy is able to deliver less correlation or less exposure to some important fixed income risks like the short rates or the term spread. And this is particularly important when it comes to the multi-asset allocation that we discussed at the beginning. Picking up this strategy compared to a traditional defensive strategy will allow you to have less correlation with the fixed income component of of the multi-asset portfolio. And with these three benefits, we go into the fourth and more important, which is the management of volatility peaks, which we discussed also at the beginning. So what's happening is, in practice, you have a very well-constructed low volatility factor portfolio, and we discussed the steps in the previous slides. And then you overlay it with the maximum volatility protection risk control. This risk control, as we see on the graph, is allowing you to manage the volatility peaks better than the traditional defensive and better than the cap-weighted index, and improve your downside risk protection. And a few words more on this risk control. The way it operates, it's trying to protect the underlying low volatility portfolio at the level of its historical volatility. If a forecast about the upcoming volatility turns out to be higher than the historical volatility of the low volatility index, then the risk control is activated and is giving you a short allocation to a cap-weighted overlay to reduce exposure and manage volatility peaks. This overlay is reviewed weekly, and we have a buffer rule so that the allocation is only triggered when there is a change in weight above of 20%. This in practice means that you expect some reallocation to happen every month, or in other words, it's a way to manage small reallocations that don't make sense and introduce a lot of turnover in favor of more important and significant information from the volatility calculations. So the vol protection overall is a simple mechanism, is an overlay on the low volatility factor, can be very efficiently replicated through futures on the cap-weighted benchmark, and is allowing you to protect volatility on the upside, or in other words, protect your risk on the downside. With this in mind, it's worth mentioning a few things about our dynamic defensive solution and how this presents itself with respect to some results. So the first thing we want to show you is that the dynamic defensive solution is giving you a better market beta conditionality. For example, if you focus at the lower part of the table, we split the market beta calculation to the periods where we have a low volatility market, so returns are of low vol, and a high volatility market, returns are of high vol, we are probably in a crisis or some distressed market, etc. What happens with the dynamic defensive is that it's able to reduce the market beta in those periods where volatility is high. It's exactly those periods that you want the market beta to be decreased. This does not happen for a traditional defensive strategy. In practice, you see that the beta can increase during these periods, and that's why you cannot avoid these spikes of volatility. Similarly, if you look at the percentage volatility of the strategy in these two regimes, you get the same picture. During a high vol regime, the volatility of the dynamic defensive is roughly 16%, which is much lower than the approximately 23% of the mean vol portfolio. So you get this nice dissymmetry, you get this nice conditionality of market beta, which is allowing you to manage the downside much better. Now, in terms of long-term returns, you can see here that the dynamic defensive is able to reduce average volatility in terms of annualized volatility numbers by 38% relative to the cap-weighted benchmark. whereby a traditional defensive portfolio will only do that by 16%. So this means that you get a very nice Sharpe ratio improvement, very high at 43%, whereby the mean vol portfolio can only give you an extra 15% of Sharpe ratio. And as a reminder, you can see that the factor intensity of the dynamic defensive is much, much higher than the traditional defensive, on top of the very strong exposure to the low volatility factor, which is giving you the premium over the long term. Yes, this is what we wanted to show you in terms of the dynamic defensive. I will move on to a brief conclusion of the topics we discussed today, and then hopefully you are free to send us your questions, and we can probably have some time to discuss a few of them. In conclusion, we have seen that many clients try to have low-risk funds in probably in the context of multi-asset funds, but they experience a problem on the fixed income side, which is supposed to be the non-risky part of the allocation. In the current environment of high inflation, potential more rate rises, this becomes less efficient and less effective as part of the multi-asset allocation. So what we saw today is that investors can think of a strategy, an equity strategy, with a well-controlled volatility risk component to be part of this portfolio, to substitute the fixed income part of this portfolio, and give investors a benefit in terms of the way they allocate in their multi-asset portfolio. And before we turn to questions, I wanted to just mention 3 key takeaways for us. First, we saw today that our dynamic defensive solution is very effective in smoothing the effects of volatility when compared to other traditional defensive strategies. Number 2, we showed today that using our dynamic defensive equity index, you can actually, as an investor, increase your exposure to equity for a given level of risk. And number 3, we think that you should consider this strategy as a substitute, or at least in part, of the fixed income component of a multi-asset portfolio, since we are now in the middle of a macro environment of high inflation and rising rates. So this is what we wanted to convey today, and we're more than happy to have your questions.